Hello everyone. Hi, I'm Manas Ranjan Sahu, and I'm here to present my final caption project for the FinTech course that I took up at UC Berkeley. I hope you can see my screen over here. So I'm just going to start the sharing and just talk about what the project is. So the project that I have finalized for the Capstone project is called Financial Partner for Life. So let me just give you a brief overview about what exactly this is. Now, when you look at a quote from McKinsey and Company, you can see that by 2025, the Gen Z is expected to represent 27% of the population, and they are going to naturally inherit a lot of wealth as well as older generations move on and share their wealth with the younger generation. And it is assumed that around 33 trillion of assets is going to be in possession of the Gen Z as part and by 2025. Now, as you can understand, 33 trillion is a good, big amount of money. And now, obviously, that makes the Gen Z quite important for any kind of banking and financial institution. So while we know that, I mean, this obviously brings up a problem for the traditional banking institutions that how can they be not irrelevant for the millennials or Gen Zs because they are going to be the future customers for them, and how can they actually make sure that they are the customers in the future too. So that's why when I say avoiding the creepy treehouse effect, it is from effect that when people have tree houses and kids do have tree houses, and soon parents do find out those tree houses and they also try joining them. And once they start joining them, then people or kids actually prefer not to use those tree houses. So that happens even with any kind of social media too. When the older generation also starts joining us social media, then people drop out of those social media channels as well. So similar to the same structure, now that every generation, older generation, uses traditional banking, so we have seen that how millennials and Gen Z start using neobanks or the digital-only branch banks in nowadays, and do not tend to use traditional banking institutions anymore. So that's a problem for the traditional banking institutions, and we are here to talk about what can we do to solve that particular issue in which the traditional banking institutions can still survive and have the millennials and Gen Z as their future customers. So let me just go over the pain, the overall summary of the pain that they have. So as I mentioned already, that because technology has made everything so democratized that it is very easy to set up banking institutions, and that's why you can see a lot of new banks using fintech are creating a lot of new banks, and they have been excelling at providing best digital experience to customers, and that's why they have been able to get a lot of millennials and as well as Gen Z as their customers too. Now, because they're able to do that, that's what they're eating up at traditional banks business. And also they provide a lot of online only features, which makes them quite attractive for millennials and Gen Z. Now, as we discussed that there is going to be a natural transfer of wealth for the millennials and Gen Z, and that makes them the future target audience for traditional banking institutions. And the only way the traditional banking institutions can survive is by looking at what is the preference for those millennials and Gen Z or the future customers. And if they prefer digital banking, then that's the way forward. And that's why they have to start looking at how they can improve the current operational expenses that they have, how can they reduce it and invest in more digital infrastructure for in order to provide a better experience to those future potential customers. So as part of it, here is what I'm actually suggesting here. Why don't we create a fintech product called Financial Partner for Life? Now, what that would do is that is going to be a one-stop shop which will be aimed at maximizing the wealth and for the customers, and also build experiences around wealth creation itself. Okay. Um, so what it would do is like it is going to create a digital preferred account for the customers, and wherein instead of having cash-based rewards or points-based reward systems. This is going to have an experiences-based reward system. What that would do is that based on your preference, based on your choice, you'll be actually getting that as a reward for investing in the bank or investing your money with the bank, right? So this digital preferred account is going to make them a preferred. It will make the digital servicing as a preferred criteria, and any member or any customer who joins that particular product is going to have the digital servicing as a priority for them, and they will also be expected to receive the best-in-class digital experience as well. Now, as I mentioned, we are going to have an experience-backed reward system. What that means is that as and when the deposits grow with the bank, then the members or the customers are going to get more and more rewards or paid off subscriptions or experiences for having more and more deposit with the banking institution. That way, the wealth which is currently with the millennials and Gen Z would actually move into the bank for safekeeping, and the bank could actually get some income out of it. Now, that income, a part of that income that they are going to share it back with the customers would be in the terms of providing them with paid off subscriptions, providing them with experiences which are already paid off, and also providing them with free enrollment into other additional ancillary products within the banking institution. Things like, let's say, providing them insurance products, things like providing them with investment products and investment services as well. So it is kind of like it is going to promote them to have more and more deposits with the bank and get more and more free experiences and free additional financial products as well. So this way it will be helpful in improving the overall growth, wealth growth of the member, and also it will it will allow us to personalize their overall rewards journey experience and their wealth growth experience too. So this is the business model canvas for this particular product. As you can see on the right hand side, we have the customer segment. The customer segments are going to be millennials, Gen Z, and employees of high-tech companies who are more prone to using digital products. Now, when you look at the channels, it is going to be available and on the App Store, on the Play Store, as well as on browser websites, so that all kinds of channel, whether desktop as well as mobile, is covered. When you look at the customer relationship, this is going to provide additional financial services as part of the reward system, and it is also going to provide tiered reward system with incremental value. What it means is that as you invest more with the bank, you're going to get incrementally more and more reward from the bank. Things like more and more experiences, things like more and more subscriptions paid off, things like more and more free enrollment into investment platform, into insurance platform, all that stuff. The value proposition, as I was talking about, you can see that it's a single account for multiple financial needs, and it is an experience-backed reward system, which will prioritize the digital experiences by more, and it is also going to give them a priority in getting service through a digital channel for any of the issues. Okay. Some of the key activities that will be part of this product are fraud security, legal compliance, app or website development, service maintenance, marketing, and investment in low risk avenues, so that we can make sure that our customers' money is secured. Now, some of the key resources that will be available for this product would be available on the app or website. You would have an investment and insurance arm linkage as well. Okay, and you'll also have subscription partner linkage. Those are the things that we have to make sure that we are having it available for this product to be successful. Now, some of the key partners for this product to be successful are subscription companies like Spotify, Amazon, Google, or Netflix, who are going to provide the subscription services, which will be paid off by the bank for investing more money into the bank. You would also have the insurance and investment arm of the institution, who will be also key partners. Now, usually in banking institutions, those insurance and investment arms, they work in silos, but this is going to help the bank to actually group them all together and work towards the single purpose of growing overall customer growth as well as overall wealth growth within the bank. When you look at the cost structure, some of the costs that will be incurred are operational expenses, the subscription cost that will be paid to partners, as well as additional financial services costs that will be paid to the other arms of the institution. But now, how we're going to get the revenue for to meet those cost structure would be that we can charge those digital only customers for visits to branch if they really need to visit. Okay, they would be provided with some free branch visits, but beyond that, they would be charged for the branch visits. That will be one source of income, even though very minuscule, considering that they usually prefer digital servicing. You'd also have a lower customer acquisition cost for additional financial services because now you can make sure that the same customer is actually going to the investment as well as the insurance product. So that reduces the customer acquisition cost, and that is an operational expenses that will be saved. Then you'll also have an interest income from the deposits, which will be which the customers are going to make, and that is something that you can utilize in loans and get the interest income out of it. So that is a revenue stream as well. On top of it, you'll also get a percentage of commission from the affiliate companies or this subscription companies, because through this we are actually increasing their overall membership count as well. And for increasing their membership count, we could actually charge some kind of commission from them as well. Now, what are the different factors that drive this innovation? There are primarily macroeconomic and technological factors which are involved in here. As we discussed, like Gen Z and Millennial are going to receive 90 trillion as an inheritance by 2044. And as we all know that if those future customers actually move to new banks, that means we'll be losing a long-term association, and that way it will be a big loss to traditional banking institutions. Also, we can see that pandemic has led to a wider acceptance of online-only operations, and you can see a lot of online business applications booming because of that. Some of the technological factors which will drive this innovation are, you can see that the smartphone usage actually within this target group of millennials and Gen Z is around 89% to 96%. And on top of it, you can see that this target group actually prefers having personalized journey. So, and they are not willing to, they are willing to share the data if it is for a personalization of their experiences. So you can see 63% of the target group actually is willing to share data, and the over operational expenses of a physical location, which you currently see with traditional banking institutions, is around 3 to 4 times of a digital location. So those are the things that makes the digital location much more cheaper for banking institutions to actually sustain, and it reduces the overall operational expenses footprint as well. Now, within this product, this product within the fintech ecosystem this product is catering to the transformation of the banking and financial services space, and its primary goal is to disrupt and dematerialize the traditional banking models. Now, some of the objectives that we have as part of this product is how to package the savings products, the insurance product, the investment product all together, so that we have a lot of product depth within the customer, within the bank, with the customer. And when you have a lot of product depth when a customer is with a bank, then it reduces the overall churn, because it's very difficult for you to actually move all your assets and all your accounts from one banking institution to another banking institution, and that switching cost helps you in retaining customers too. Now, on top of it, we are expecting that we will be using the data to the fullest, and using those data, we'll be able to provide a personalized user journey to the customers, and that will maximize the overall lifetime value that we have with the customers. Additionally, as we discussed, we also plan to try to achieve some non-traditional income sources. That means through commissions from affiliate companies, affiliate marketing companies of the subscription products. So through those commissions also, we also plan to get some additional income. And those are some of the objectives of this particular product. Now, what is the value that the members are going to get? As we discussed, it is going to be a digital preferred product, and but again, this is from a trusted traditional financial institution. So while neobanks are providing the digital preferred solutions or digital platforms, but many of the new banks do not are not that trustworthy, and there have been cases of misplaced trust of the customers in those new banks too. Whereas when you look at a digital preferred product from a traditional banking institution or financial institution which has been there for like multiple number of years, for decades, then you actually know that you are actually putting your money in a more trusted space rather than putting it at a new bank and then maybe having some worry of losing the money. um, you also are trying to provide them with a priority queue from a digital priority queue perspective, and that helps them in getting service as and when they need. So that gives them a sense of priority customer kind of feeling, and that helps them in getting felt as if that they are heard and they have been catered to on a priority basis. As we discussed, we are also trying to reduce the overall physical locations through this, which is going to reduce the overall operational expenses as well. And that way, what will happen is we are trying to, we will be providing every customer who is part of this product a few physical location visits for free. But beyond that number, there will nominal charges that they have to pay for any visit to a physical location. On top of it, loyal customers will get annual subscriptions paid off, and they will get access to preferred streaming services, annual membership accounts, and customers will also get referral rewards for building the overall customer base for the bank, as well as building a kind of a network effects when you have more and more people within the banking institution itself. So this is how we are going to achieve the overall one-stop solution for the customers' banking, their insurance, their investment needs. Now, what is the strategy that we plan to use for success? So some of the high-level strategy that is mentioned is, as you can see, there is an acquisition strategy on how we want to acquire new people. Then there is a retention strategy on how we can retain the customers that we have acquired. And then there is a revenue strategy on how we can increase the revenue through this product. So from the acquisition strategy perspective, what would be the option? What we are going to look at is how to highlight improvements from competitors and show the value provided to the customers. That way they know that they are actually getting into a product which is actually good for them, and they are actually getting a benefit out of it. We'd also try to make sure that they get a frictionless onboarding experience with minimal data capture, and that would also make sure that people do not have to give second thoughts when they're trying to all get onboarded. And the lesser data that we ask for from them, the easier it is to actually get new customers in. Now, once we get a new customer, that is the job is not done, because you want to retain them for the future as well and make sure that they continue to use the product too. So that's where the retention strategy comes into play. And here you can see that we can have a retention strategy that we can reward their loyalty. If they continue to stay with the banking institution for longer, then we'll try to provide them with more and more paid off subscriptions. We'll also offer them with additional products like insurance and investment if they increase the overall deposit with the bank. That makes sure that they are actually willing to put their wealth with the bank, and that's why they need to be rewarded for that. On top of it, we'll also try to make sure that they are actually referring others in their network into this banking institution. So what would happen is that will make sure that they are helping us in doing more and more customer acquisition, and that reduces overall customer acquisition cost for us, and helps build some kind of a network effect when your near and dear family members are all within the same financial institution. You would not choose to like drop out of it and then go to a competing financial institution. The third strategy is the revenue strategy, which is mentioned here. And what it does is how to increase the overall revenue from this product. Some of the things that we have to consider is how to get more and more interest income from the loans, from the deposit that is being made. How we can get income from affiliate marketing of the subscription companies, and also how we are going to get more and more customer growth by maybe having some kind of corporate tie-ups with the subscription service orgs as well. So what that means is like, let's say we have a corporate tie-up with Amazon Prime, or we have a corporate tie-up with Spotify. So that way we can try to get more and more customers, or more and more employees of Amazon Prime, or more and more customer members of Spotify as our customers as well, through corporate tie-ups, so that any newcomer does get to know about us, and there's a higher chances that they get their new direct deposit account or their salary account created with us, and that would obviously make sure that we are able to increase the overall deposit as well as customer growth for us. Now, what are the different technologies that will be needed to make sure this product is a success? So here I have mentioned what are the different modules where this technology will be implemented and what is the benefit that we can get. So the first thing that is mentioned here is the onboarding process module. And as part of that, what we plan to do is try to validate customers using minimal information, right? So things like when you look at a company called Proof, which uses or which validates people just by using their phone number. So we can try to follow similar structure or use the services of Proof to validate customers using just their phone number and onboard verified customers using just phone number. That way, the need to ask for multiple questions is done with, and because it reduces the overall friction in getting onboarded, the verification time is low, and also customers would not think twice to get onboarded when you have such a low friction. Now, the next module is document request, and as part of it, what we plan to do is use OCR to scan requested document and capture any information directly into forms. This is going to reduce the overall time that it takes for customers to provide information to us, and it also saves the employees time in verifying the details that have been put is correct or not. So, using technology of OCR, we can reduce a lot of time for both the employees as well as for customers. The third is in the transactions module, we can use AI/ML models to track and flag fraudulent transactions. This would be kind of a proactive flagging, which will make sure that any fraudulent transaction which doesn't confer with any of the traditional transactions that the customer does will be flagged, and the customer is going to be notified. Now, this proactive flagging is going to help the overall customer satisfaction scores, because we are not going to make them go through the whole filing of a fraud report by flagging transactions beforehand. And the last module is the investment profiling. What it does is we can use AI/ML and gamification to determine what is the risk appetite of a member, of a customer, and based on the customer's risk appetite, we can provide them with different investment profiles or investment models which they can follow to grow their overall wealth based on their risk appetite. Now, in order for us to measure the success, we would have to make sure that we're tracking all the different matrices as well. So some of the metrics that will be at play are when you look at the awareness aspect of it, how aware our customers are about us. So it'll be the number of people who visit us organically and the number of people who visit us via sponsored links. We'll be tracking that to understand how our awareness about the product is across the internet. The next is acquisition. So once people are aware about us, and are they actually applying for the product and actually starting the product application for this product or not? So as part of acquisition, we're going to measure the number of people who submitted the application as well as the number of people who started the application. So both are important, because you can have people who started application but did not submit, and if you see a difference between that, you can try to understand which part of the application process is causing friction for the customers to not submit the application. The third is the activation, and it is while you have acquired customers, now you have to activate them. That means they should be starting to use the product more and more, and they should start to increase the overall deposits as well. So as part of it, we're going to start looking at how many people actually fund the account within 7 days of account open date, and how many people who have performed at least one transaction with that particular account. The next is the retention matrices, and as part of retention matrices, we're going to look at how many people have achieved age of 180 days at least. Okay, that shows that we have been able to retain them for 6 months, and anyone who has been with a financial institution for 6 months usually stays there for a longer period. The other metrics that we can capture is, let's say, the number of customers who have increased the number of product that they have, so that they have started with, let's say, a checking product. Now, have they also got a savings product? Have they also got an insurance product? Have they also got an investment product with us? So that tracking that will show that they are actually interested in continuing to do business with us, and that's why they have increased the number of product that they have uh, with us. The next is referral matrices. What it deals with is how the product is being referred to by existing customers to others. So the matrices that we're going to capture over here is the number of customers who have been acquired through referrals and the dollar amount of deposits that we have received from those referred customers. So that will show us that what is the overall value that we're getting through the referrals. The last matrix that we're going to consider is the revenue matrix. And as part of it, we can track how much is the dollar amount of deposit that we have received, what is the amount of net interest income that we have attained by using this deposit amount into loans, and what is the amount of affiliate market commission that we are getting by providing the different subscription services. Now, moving on to the financing strategy, like how exactly are we going to finance this? Now, you have just provided like a ballpark idea on how exactly we can come up with a valuation for this particular product, and using that valuation, we can pitch it in front of the different investors. So usually the estimated valuation for a fintech could be determined by a discounted cash flow method of future cash flows, or you can have a valuation multiple of current revenue streams by looking at the industry and then multiplying your current revenue stream with that particular valuation multiple. So the steps to determine valuation would be, like, first we'll estimate what is the total addressable market size, and what is the serviceable addressable market size for this particular fintech product. And we start off with one particular SAM, serviceable addressable market percentage. So let's say we consider that, okay, we can easily achieve, let's say, 5% of the SAM market in the first year. Okay, within the 5% of the SAM market of millennials and Gen Zs, what is the net interest income from an average deposit that we're going to get? Okay, so let's assume that we have 330 million people in the US, and 1/6 or 1/5 of them are in the or 1/4 of them actually would be, let's say, in the millennial and Gen Z category. So of that 1/4 people, if we are able to get, let's say, 2% of people in the first year for this product, what is the that will give us around, like, so 330 million, and so 1/4 would be around 75 million, and of that of that 2%, if you're getting, so that is around 150K people. And within that 150K people, what would be the average deposit? So let's say an average deposit of 25,000 or 30,000 is what we get. So of that average deposit, that 25,000 money, if you're investing it in loans, what is the interest income that we're going to get? That will be our cash flow that we are getting. Now, as the years progress by, the overall average deposit is going to increase, as well as the average net interest income is going to increase, and the overall customer base is also going to increase. That means the percentage of SAM market that we capture, that will also increase. So we have to keep all the three factors increasing order. Like, let's say, a growth of 5% on each year by year, we can try to assume, and start understanding what is the net interest income or cash flow that we're going to receive as part of that projection. And once we have a particular projection, we are going to find the net present value of money, and using that, we can find out what is the valuation of the financial fintech product that we have built. We can also do an different calculation using the valuation multiple by looking at the industry and trying to understand what exactly would be the valuation multiple for this fintech product, and use the first year's revenue stream and multiply that with the valuation multiple to get an approximate valuation. Now, using these two valuations that we have received, one through the cash discounted cash flow and the other is through the valuation multiple, we can come up with an average valuation. And using that average valuation, we can reach out to different investors for funding. That will decide what will be our valuation floor as well as what is our valuation ceiling, and it will help us in having discussions with the investors and get a better valuation from them for investment. Now, while we do this, there is obviously going to be not everything is going to be hunky-dory all the time. There could be a lot of risks while we invest, while we build this particular fintech product. Some of the risks which I feel are important to be highlighted are mentioned here. One of the risks that I can think of is that there could be a lot of legal team pushback because the insurance and investment products are not FDIC insured, whereas our deposit products or saving products are FDIC insured. So there could be a lot of pushback from legal teams regarding that. Um, what we have to make sure is that will be providing all the information upfront to the customers, and the non-FDIC insured products are optional for the customers. We provide them an easy avenue of getting themselves enrolled, but there is no compulsion for them to actually getting enrolled into non-FDIC products. So, and none of the non-FDIC products will be actually backed by the any of the FDIC insured product. So that way we can try to cater to those that particular issue that could be raised by the legal team. The second risk that I can think of is there could be a lot of competing copycat products in the market. There is no such intellectual property that you actually can build in this idea, which would prevent anyone from copying the same idea. Now, the only way we can avoid that is by building some kind of network effect. So what we have to do is we have to promote the referral rewards more and more the moment we start this product, and that way we will be able to get more and more people enrolled into this product. And once they are able to be enrolled for at least 6 months, then it will become kind of a habit for them to continue to be with the financial institution. Now, once you have built a considerable amount of customer base, that will help us in competing with any other competitors who's trying to build a similar product like us. The third risk that I wanted to highlight over here is that there could be a lot of customers or few customers who just want to join this financial product just for the free subscription rewards. They are not interested into actually in the product, but they're looking at using this product just to get free subscription, paid off subscription as well. So for those kind of customers, what we can do is we can have some kind of clause in terms and conditions, which will make sure that if they, let's say, drop out within a year of being with the financial institution, they would have to pay the remaining prorated subscription cost from their account. Okay, if they stay beyond a year, then yes, that is covered. But if they try to drop off, let's say after 3 months of being with the financial institution, they just try to drop off so that they can continue to avail the subscription for the remaining 9 months, then they have to pay off the 9 months prorated subscription cost while they get out of the relationship with us. The last item that I wanted to highlight in here is that the investment model that we build for our customers, if it is not performing as per the customer's risk appetite. So the only way we can avoid this is by providing a periodic risk appetite evaluation, and we have to use the gamified AI model that we discussed during this course, within this FinTech course, to understand the risk tolerance level of the customers. And using that gamified AI model and understanding the risk tolerance that they have, we have to adjust continuously the investment model that we want to subject that particular member to. And having this frequent evaluation would help us make sure that the investment that they have is not performing badly, but it is as per the risk appetite of the customer. So with that, those are the overall ideas that we had that I had as part of this particular product. And yeah, that's all that I wanted to share as part of this presentation. I hope you liked it, and I hope this is good for everyone. I hope this is something interesting that you found. Thank you for the time that you have given me. Thank you and have a great day. Bye.